that's the risk I see, because valuations are in the same ballpark really as they were before the dot-com bust, and we have the same kind of dynamics. We have the same kind of exuberance. When that ends, when people who have made large amounts of money, and now some of them are leveraged, and so they will lose most of their assets, like in no time, and that will stop their spending in their tracks. And I'm sure that we will get a recession if there's a significant stock market sell-off.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. After embracing the no landing narrative last year and later unleashing animal spirits after the presidential election that drove stocks to record levels of euphoria, the national mood has turned substantially more dour. Suddenly, the headlines are filled with fears of recession. The post-COVID higher cost of living and the uncertainty caused by the new administration's policies has many fearing for their household budgets, their portfolios, and their jobs. So, are things really this bad? After all, the economy is still growing, inflation's moderated mostly, and unemployment remains low. When there are so many crosscurrents as there are today, it's prudent to seek the counsel of those who take a cold and calculated look at the data to see what is versus what our biases may want us to see, which is why we're fortunate to speak with macro analyst Wolf Richter of wolfstreet.com today, who will share with us what the charts he regularly compiles are telling him about the true state of today's economy and markets. Wolf, thanks so much for joining us today.
Thank you, Adam.
All right, Wolf. Well, look, thanks so much for coming back on. And, in that intro there, I talk about the various crosscurrents. I know from your previous appearances on this channel, you're coming back a little gun shy because there is a vocal minority on here that when you present data that isn't necessarily matching their preconceptions, they push back pretty hard on it. And look, I think that the whole reason this channel exists, right, is to try to help people get a better sense of what's truly happening so that they can make more informed decisions going forward. And an important part of being an informed person is to keep your mind open to the data and to certainly let challenging data come into the picture so that you can either revise your preconceptions or defend them if you feel your data is superior, right? So anyways, I appreciate you coming back on here, Wolf, and all I want you to do, which I said when I invited you back on, is just tell us what your data is telling you, and then we'll let the audience, choose accordingly, whether they find it compelling or not. But folks, I just want to say, don't shoot the messenger. Wolf is just here sharing with us the data that he looks at, on a daily basis, and Wolf is one of the most respected data analysts and chartists out there. So anyways, Wolf, it's a pleasure to have you back on.
Thank you, Adam.
All right. Well, look, my friend, why don't we start with my normal kickoff question, and then I'll get into the details. What is your current assessment of the global economy and the financial markets?
There's a little bit of chaos going on right now, I think, in terms of uncertainty, and not actually chaos in how things are really working, but in terms of just the enormous amount of uncertainty that the Trump administration has thrown out there. And some of it is really needed and good, and so I'm not going to say it's all bad. But anytime you change something as huge as the United States economy, or even huger, the global economy, which is kind of what he's trying to do, you're going to have a lot of uncertainty as to how this can even be implemented, how this will work out. And each country is struggling with their own interpretations of these issues, and it affects countries differently. And so there's this chaos and uncertainty right now. It's kind of astounding, and it's I can see this in the commenters on my side. It's kind of entertaining, because people are just stunned and amused to some extent by all the different things that are being thrown out there on a daily basis. And the tariffs, they come and then they go, and then they come back, and the layoffs that are happening and then unhappening, and it's just kind of total utter chaos and uncertainty. And but I have to say that ever since I had my website, which is a long time ago, I have uh, screamed and yelled about the twin deficits of the United States, or the fiscal deficit, uh, and it's a budget deficit, and the trade deficit in manufactured goods. I think both of them are really a bad situation for the United States. We've abandoned manufacturing, and we've abandoned any kind of fiscal discipline. And I see a lot of good in these efforts. And I also like that they're focusing on the real economy that has been stated explicitly, rather than in some financial aspects of it. And so they're, I'm not really for chaos and for this uncertainty, but I can see why they're doing this. They're trying to address these two issues, and these are precisely the two issues that bother the other countries. The trade deficit of the United States has been a huge benefit to other countries, and the fiscal deficit, throwing these trillions of dollars out there into the world, that also has stimulated demand globally. And so they're in a different boat. They're on the other side of this fence. So what would benefit the United States might not benefit those countries, and that's what they're really and seriously worried about. And they have those concerns legitimately, I think. And I mean, like, you're looking at Canada. They're, in addition to all the ridiculous verbiage that Trump has thrown at Canada, they are dealing with some serious economic uncertainties now. And so, in terms of the global economy, these are issues that will have to be dealt with. And I don't think it's unmanageable. So I don't really think there's going to be a huge issue with that. But nobody likes that much uncertainty and having the plans sort of messed with, and you have to come up with new plans and adjust to the new reality. And that's just not a really easy thing to do. But I think from the United States point of view, it's important, and it's a to attack those twin deficits. I think is a really important thing, and it's finally happening. And maybe it's happening the wrong way, and maybe it's happening in a too much of a chaotic way, but they are trying to make that work.
Okay, so a couple quick clarifiers there. One is, from your comments, I guess I would assume that you would say, look, if we don't address those twin deficits head on, at some point we're going to be forced to by reality, and in a crisis. And so potential kudos to the current administration of being somewhat proactive. I mean, I think many of us would say it's late in the game for the American political system to address them, but at least hopefully they're addressing them before they become an absolute crisis. So points for that. But to your other point you're making, you know, once the status quo gets in place, especially if it's been in place for a long time, there's a whole power structure that evolves that benefits from maintaining the status quo. And so when you have a disruptor come in, like the current administration, it gets fought everywhere. It's unpopular everywhere because you have all these vested interests in the status quo continuing, and the disruptor, by definition, is trying to blow up the status quo. So you're nodding as I'm saying all this, but basically,
Yeah.
I'm capturing your thinking correctly here.
Yeah, very well.
Okay, all right. So that's what's happening on the economic side now. Uh, can't really tell exactly why the markets have been selling off, but we can say there's a lot of correlation between this chaos and uncertainty and the markets being displeased, at least stocks. So, do you have any general thinking, general thoughts right now in the stock market, whether from valuation levels or, trajectory wise? I don't want to put words in your mouth. So what's your general current assessment of the financial markets?
Well, I think I've thought for quite a while that stocks in general are vastly overvalued, that they're trading at very precarious levels, and that they're very much at risk of a major sell-off. Um, and in part, they are so overvalued because the Fed has had, during COVID, these these enormous money printing policies, and that even though QT drained $2.2 trillion out, there's still plenty of this liquidity running around, and now we've got the government's checking account being drained by being emptied really by the debt ceiling. So that money goes into the economy, into the money markets. So you've got this additional flow of liquidity going into the markets temporarily, and it's going to get sucked out when the government replenishes its checking account. So I think that's when the sell-off will get more serious, when that's happening. And so you have an artificially inflated stock market that faces a little bit of chaos and uncertainty, and I think it's perfectly logical for there to be an adjustment of the valuations.
Okay. And I'm going to guess what has happened so far, the sell-off from 6,100 to 5,700-ish. That's not the kind of correction that you were fearing. You were fearing something substantially larger than that, in terms of both how high the valuations were and what could potentially happen with liquidity. Is that correct?
Yeah, and a 10% correction is really nothing. It's a routine thing, and it's nothing to even think about. We've had two 50% correction, two 50% crashes, one in the early 2000s, and the S&P 500. In the S&P 500 plunged 50%. The Nasdaq plunged 78% over those 2.5 years in the early 2000s. And then we had another one during the financial crisis, another 50% crash for the S&P 500, and the Nasdaq didn't go back to its pre-March 2020 level. 2000 level until 2015. So it took 15 years for the Nasdaq to catch back up, and it took lots of money printing for it to do that. And so we've been spoiled here over the last 15 years by the Fed's policies in terms of stock markets just to keep going up. But that's not always the case. It hasn't always been the case. And I think a larger decline in stocks is definitely in the cards, and it would be probably healthy to bring the valuations back in line with reality.
Okay. So, all right. So stock market that's still at risk of a pretty substantial downward price correction. And that's at some point in the future. You're not putting a timetable on that. I'm not going to ask you to put one on there. But as you look across the rest of 2025, what's your base case assumption for the economy?
So I know in the first quarter, and GDP has a good chance of being negative because we've had this flood of imports, and they're negative on GDP. Then there's some other factors. So we may get that consumer spending. January, February, the worst 2 months for consumer spending in the year, after December, which is the best month. So they're using huge seasonal adjustments to lower the December figures and to raise the January, February figures. So what we're looking at is 1/5 of it is seasonal adjustments. And if they're just a little wrong, you get the wrong number. That balances out with seasonal adjustments averaged out over a year or zero. So they zero out. So when they're overdone in some months, they'll be underdone in other months, and so it'll average out. So I think the beginning of the year is not going to be a strong growth number. It could be negative. Then the rest of the year, I kind of see where the Fed is going. The Fed, they in their last meeting, they had a median projection, so that's the median value of what these 19 members projected, and they figured the growth would be GDP growth would be 1.7%, which would be slower than the 15-year average, which is 2% for the United States. but it would still be a pretty decent growth rate overall for the economy, which is a little bit slower than 15-year average. Um, I think that's probably a pretty reasonable assumption here early in the year that we're looking at this. It's impossible. And my crystal ball, I got it at Walmart and it's not working very well. And so it's plastic actually. And it doesn't give me good answers about the future. But I think that's a pretty reasonable assumption that we're looking at a slightly below average growth rate this year.
Okay, so slightly below average growth rate this year. And where I'm going with all this is, um, does not sound like your base case is that US falls into recession this year. And obviously that's what a lot of the debate is right now in the headlines is, are we destined for recession this year because things are slowing? People are concerned about jobs. There's all the disruption that's going on right now with the new administration. Some people fear that that in and of itself might trigger a recession. There are other people like you and I who have been talking about a lot of risks, unsustainable risks in the deficit and debt and all sorts of other things from past years, decades even, that may be catching up with us. But you're saying, hey, everybody, slow your roll a little bit. I'm looking at the data. I'm not seeing, blaring signs that it's recession dead ahead. I just sort of see the economy just growing slightly slower as the year goes on. Is that correct?
Yeah, kind of. I mean, I do see the uncertainty. So I didn't see that last year. I think there's a lot of wild cards out there now. It's really hard to say what's going to happen in some of these things. Um, yeah, the policies on tariffs, that could be a strength for the United States. It could raise consumer prices, but it would also create more production in the United States. So that would be strong for GDP. It could give U.S. producers an advantage. So we got to remember, imports are negative on GDP. So if you're sourcing more materials and components and goods within the United States, then imports are going to come down a little bit, and so that would help GDP growth. That's a really important thing. I mean, that's one of the reasons what these tariffs are supposed to do. They're supposed to encourage production and sourcing in the United States. And if that is actually happening, that will be a strong factor in the economy. But it doesn't come without a price. So you have supply chains that get rejiggered. You've got uncertainty. You've got all kinds of other things. And there may be demand issues coming from other countries. The United States is not a big exporter, so we export a lot of hydrocarbons. So natural gas, we're the largest natural gas exporter in the world. We're national gas producer in the world. We're the largest LNG exporter. We produce we're the largest petroleum and petroleum products producer in the world. We're exporting a bunch of that. So those are our primary exports. And then we have other exports like high-end stuff like machinery and planes and military equipment and those kinds of things. And they may not be all that susceptible. People talk about exporting food, but that's a low-value stuff. So commodity, wheat, and those kinds of things. You're looking at billions. It's in the low bill. It's really not a lot of money, so it doesn't really impact our exports figures that much. It gets a lot of publicity, but it's not. It doesn't weigh that heavily in our dollar figures, and so that could be a drag, or somewhat of a drag from the export side. But if we refocus production in the United States and sourcing in the United States, and that goes from lumber, it goes from petroleum products, everything. And the United States also imports a lot of petroleum product or petroleum crude oil and it refines in California does that. We import crude oil, refine it, and sell the gasoline and the jet fuel and the diesel to Mexico and Latin America. And I see the tankers go by my window. I mean, they come in with crude oil, and the smaller tankers with gasoline go out, and they head south. And so this is a very lively trade, but that might get disrupted a little bit by the tariffs. So we'll we'll have to just. It's really impossible to forecast that, but I think that the purpose of the tariffs is to bring more production to the United States, and that would be a strong thing to have. It creates employment, it creates construction of factories. And we've seen that. We've had a factory construction boom for 2 years now, and it started really right after the Trump tariffs of 2018. So you got a planning phase. You plan, so a company says, okay, we're going to bring some of this production back. So they're buying a property, they're building a factory. It takes a long time to do all this, years. And then they're buying the equipment for the factory, get it up and running. And then we had COVID come in the middle, everything got shut down. And then in 2021, that's when we see the factory construction boom. It's a huge amount of construction of factories going on, and that's good. So I'm really excited to see that the manufacturing is coming back to the United States, and that's not manufacturing of T-shirts. That's manufacturing of semiconductors, of motor vehicles, of components, of electrical equipment, of computers. Apple announced recently it will open a factory building AI servers in Houston, and those kinds of things are really good. So this is manufacturing has secondary and tertiary effects on GDP. So that's the positive impact of all of this. So it is really hard to weigh how that will come out in 2025. I do see there's a possibility that there'll be some rough spots, and there'll be some surprises, and we may get more inflation than consumers can handle, and they decide the way to fight inflation is to stop buying stuff, which is the way to fight inflation.
Mhm.
The best solution to high price is the high price. You stop buying and the price comes back down. But that hits consumer spending, and we've seen that during the last bout of inflation in 2022. So there was a decline in consumer spending because consumers just got pissed off and they stopped buying this stuff. And many goods prices have plunged since then, including used cars. And so I would say there's a lot of uncertainty. I don't see. Last year, it was a lot easier to say. Early last year, we had this kind of conversation. It was a lot easier to say, I don't see a recession this year. This year, it's a lot more uncertain. I don't really know what kind of curveball we're going to have to deal with as an economy.
Okay. All right. Great. Well, you're taking exactly where I wanted to take it then. So, yeah, last year when we did talk several times, there were at times some reasons to be really concerned, and you were saying, look, I'm looking at the data. I'm just not seeing anything really imminent at all. Of course, you turned out to be right, but for some people that were very concerned about the scary data, they didn't believe you at the time. Now you're saying it's a tougher game to call. Now, obviously, your base case is still no recession this year, but I definitely hear you saying, hey, I'm open to being wrong. I'll just keep looking at the data. What I take from you here, Wolf, is you're saying it sounds like you're, correct me if this is right, but it sounds like you're fairly heartened by the economic policies of the new administration in terms of what long-term benefits they could bring to the economy. But in the short term, there's going to be disruption. And I've asked this question for months and months of the experts on this channel is, hey, let's assume Trump's successful in the long term. Can he be successful in the long term without breaking some things in the short term, right? And most people have said, no, he's going to break things. There's going to be prices to be paid. You've more or less used the same language here. Now, of course, the big one is one of the things he's going to break the economy and send us into a recession in the short term. TBD, again, you're not saying you see that happening. You don't see a preponderance of odds for that, at least not yet. Let me ask you this. Given that potential greater long-term optimism, when it comes to the markets and the economy, are you sleeping better or less well right now when it pertains to the short term?
Well, so short-term markets, stock market short-term is always very risky. And the large movements up and down. And if you look at a long-term chart, the theory is that long-term, it's not risky because after a big drop, it it rises again eventually, maybe many years later. And so I think short-term markets, I stick to that. That's my story, and I'm sticking to it. Yeah, short-term markets are very risky, and there I have looked at markets that stayed down for decades. So that's not the case in the United States, but that was the case in Japan. It's the case in China. It was the case in many countries in Europe, and they had a high, and they're still far from the high years ago. And so, what's the chance that this is going to happen in the United States? And we've had this huge 15-year run up in stock prices here. And I think there's a possibility that we're going to see a situation where we might not see that whenever that high will be or was, that it might just not come back for a long time. And then we'll have a sell-off, and then we'll have stagnating markets, and then we'll have ups and downs and this kind of stuff. When you look at the Shanghai stock market, it's exactly what you're seeing, and they're down over 50%, and still from the 2008 high. And in Japan, decades, they finally set a new high last year, and after 40 years. So yeah, when you have a stock market bubble like we had, it can take a long time to recuperate that old high. And I think so long term, I think that is a situation that I'm not completely sure we'll avoid. And short term, I think markets are risky for sure. And long term, I think we're looking at this scenario where we've had this huge run up, and it may just be not very good going forward.
Okay, so we could have a lost decade, more or less, like we had in the NASDAQ after .com. You cited that earlier. And there are analysts out there, John Hussman being one, who they do a lot of analysis of this in terms of when the market had the conditions that it has now in terms of sort of overbought readings, what were the returns over the next decade, or I think John does 12 years. And I think right now his model is still reporting a negative average annual return for the next 12 years, right? And Goldman Sachs, this was before the recent correction, but coming into the end of last year, even Goldman Sachs had put out forecasts saying like they're expecting, I think, like 3% annual returns over the next decade, given how high valuations were. So for a big prominent, sell side firm like that to be that pessimistic really said something to me.
Yeah.
Yeah.
I mean, it's impossible to forecast what's going to happen for 10 years, but these scenarios, I think, are not unlikely.
Okay. All right. Well, so let me put up this one thing and then let you kind of give a counter to it. So you were talking about consumer behavior and cure for high prices is high prices, and but that impacts consumer spending, and we're a consumer spending driven economy. Here's a chart I just saw earlier today, which is expected change in real income during next year. You see this chart, Wolf?
Mm-hmm. Yeah.
Okay. So this is basically the lowest reading we have in this data set, going back to the 50s, I think, or the early 60s. And this is survey data. It's more sort of sentiment, it's more belief, but beliefs
So
are.
let me ask you, interrupt you for a second.
Yeah.
So on my screen, it looks like it's kind of hard to tell because it goes back so many decades and he doesn't have a lot of detail, but it looks like it bounced off in 2022 and is now higher than it was. Do I see this correctly?
It looks like it's bouncing. Yeah, I guess it was lower a little while ago.
A little while ago, yeah. So
It
without time
bounced a little bit, it came
yeah.
back down a little bit, but this general period we're in is still very low, right?
Yeah. So like you said, sentiment, but inflation. So this is a chart that tracks income adjusted, expected income minus expected inflation, essentially. And so the change in real incomes. So this involves inflation. And we've had this huge bout of inflation. And so when consumers see inflation, they properly calculate that into their income expectations, but with a lag. So inflation diminished from the huge spike we had, and uh, yeah, it was 9%, and it came down a bunch to a lot smaller figures than that, depending on what index you're looking at, and into the 3% range. But for consumers, it didn't come down from 9% that quickly. It took a while to come down, and so there's this lag effect, and so I can see where they they thought with this lag effect that there would be more inflation than there actually was at that point in time. There was more inflation 6 months earlier, but yeah, so that this lag, and I think what this chart shows is the movement of inflation or the perception of inflation, and we can see a little bit of decline. The most recent data points in that chart, and we've had this increase in inflation over the past 6 months. So, and consumers are noticing that this stuff's starting going up again, and it's now good. Suddenly, they're getting more expensive after having dropped, and some of the services are getting. Uh, I got my car insurance came down. I mean, I've never seen anything like that. It doubled over like a 3 year time span, and then now I got my new rates in, and it came down a whole bunch. And so there's this effect too. We forget about that. Some of these price increases get rolled back, and some of the goods price increases were rolled back, and now they're coming. They're resurging in many cases. So I can see that a little bit. That consumers are seeing that. They're buying this stuff every day, and so when goods prices go up, they see that instantly. When the car insurance goes up, they don't see it until they get the new premium, and so there's a 6 month lag there, and so I can see that it's a reflection of consumer perception of inflation more than incomes, and uh, and consumers are pretty accurate about their inflation perception, but there's a lag, and so I think that's what we're looking at. Is when there was low inflation, there was a high real income expectation growth. And when there's high inflation, the real income goes down. And we've seen that real incomes were negative during the bout of inflation. They jumped up a lot, but the actual incomes they were lagging. And so we've had pay increases that lagged inflation by about a year. And uh, and so consumers got hammered in 2021, 2022. Then the pay increases surpassed inflation rates. Inflation was coming down, and so consumers got more money than inflation rates at that time. And you can see that in the chart. It's just the up and downs that you see. This wave movement is really the expectation of inflation eating your lunch, essentially.
Right. And I guess the reason why brought that up was to say, uh, if we have these record low readings still, presumably that is going to influence people. It's going to influence their spending, right? They're going to be uh, less willing to spend, and some of them very well at this point are probably less able to spend.
Yeah.
In fact, I won't get into the weeds of the data, but I know you track delinquency data and whatnot, and for all sorts of consumer loans, we're seeing the delinquency is starting to rise and whatnot, right? So on one hand, you've got some data here that suggests that, hey, the consumer may start really belt tightening later this year, which could slow the economy even further, right? Um, I'm curious what you might have to bring to bear data-wise on the other side of that to say, yeah, that's a concern, but these are some of the things here that you think are going to keep the economy still in positive territory throughout the rest of the year.
So we've seen the sentiment surveys do some crazy things. So the University of Michigan Consumer Sentiment Survey, for example, it has a political split.
Right.
So it shows Democrat-leaning and Republican-leaning consumers. And when Trump got elected, they crossed over. you know.
Yeah.
So this is hilarious. I mean, you cannot take this seriously. This is a depiction of a political society, and not of an economy. And your inflation expectations are worthless when it depends on whether you're Democrat or Republican. It suddenly doesn't mean anything anymore other than it's a political statement. So when you look at the Fed's consumer expectation figures, and they don't go into the political divisions, and so maybe they're less. Yeah, the consumers don't. When you fill out a survey for the Michigan Consumer Survey, you say you're Democrat leaning or voted for Democrats, those kind of things. The Fed surveys don't do that, and so they're not seeing a big spike in inflation expectation. They've now seen a small increase because there's a lot of talk about tariffs, and so you now see the inflation expectations coming up a little bit. But they don't see this gigantic spike that Democrat-leaning survey respondents wrote into the survey at the Michigan survey, and that's just useless, that data point. So, and also we've seen that it doesn't impact consumer spending. Actually, these surveys are reflecting the perceptions of these consumers. They still spend, and incomes are high, unemployment is low, jobs are really just lots of them out there, and some sectors still have labor shortages, and that may get worse as the illegal immigrants get hauled off. So you've got a little bit of that going on. The labor pool is going to shrink because of that, and that will put upward pressure on the lower end of the wage scale, and that's good. I mean, that's what we need. That's a good policy to have, and you're bringing in these illegal immigrants. That's a form of wage repression, and at the very low end of the scale, and trying to put a stop to that, and trying to get back to where immigrants that come in are legal and proper, and that I think will be beneficial to wages at the very bottom end of the scale, and that's important. Their inflation hurts the most, and so there's some delinquency rates that went up a little bit, but they're still very low. Credit card balances reflect spending, so we run $6 trillion a year through our credit cards. That's how we pay for stuff. So when you look at credit card balances, the data is statement balances, and most of them get paid off. The balances that carry interest are only there's 500, 600 billion have credit card balance have interest, so they're the revolving balance that people carry and have to pay interest on, and so it's a pretty small amount. And consumers are flush with cash. There's $11 trillion in money market funds and CDs in households, and there's stock rally has gone up. House prices, 65% of the consumers own their own homes. So the home prices have shot up, and people have access to that equity that can take it out. We've seen home equity lines of credit become a little bit more popular now, and so I don't see consumer spending getting hit. The consumer is not hurting. They're pissed off about high prices, that's for sure. Americans hate high prices. We've got high prices and people hate it, and it pisses me off too. And I go to the store and I see these prices and I think they're ripping me off. And my wife just kind of closes her eyes and buys it, and I don't buy it, and I come home without it. And then she said, "Why didn't you buy it?" "Well, they ripped me off." And then we don't have eggs because I didn't want to pay $8 a dozen for the eggs, and now they're back down below $5, and I'm buying again. So that's a typical reaction, and so we get pissed off about stuff, especially high prices, and we show that in the surveys, but spending has been good, and so it for consumer spending to really turn like within a month or two, you have to have some violent shock. You have to have something really big happening, like Lehman Brothers going bankrupt. I mean, that's when consumers got scared and bam, everything shut down. And during COVID, everything got shut down by the government. So you have these kinds of shocks, but when you don't have those shocks, those external shocks, consumer spending doesn't really change that much. If you smooth it out over 3 months average, it's a pretty smooth line. It keeps going up, and so these little ups and downs month to month, that's just data noise. It just goes away with the next month or two. and the seasonal adjustments, that can be off. So unless there's a big shock, so if Trump's policies exert this big shock on consumers, where they say, "Oh, well, I'm scared now. I'm not going to buy anything for a while." Yeah, unless this happens, I don't expect consumer spending to come down in any meaningful way.
Okay, so I just want to dig on that for a little bit. So it sounds like you're saying in general, I heard some terms like there's plenty of jobs out there, consumers are flush with cash. Um, I'm going to guess you might get some pushback in the comments from people who that doesn't match their daily existence, but it's a spectrum out there. Um,
Okay, so let me just jump in there. So we're talking about the overall economy. This is not a social studies interview here.
right, right,
Okay.
right. I know. Well, let me get my question there because I think you're going where I wanted to go, which
Yeah.
is, when you talk about the consumer doing okay, pretty okay, right, is what I take from you. I think you're talking about on average, right? And my question there is,
I'm talking about the overall economy.
yeah,
Now that's a really big thing. So we have homeless people, so we have poor people, the poverty range, and we have people that are struggling. And then we have people that are flush with cash and have lots of money and can spend. And so we can focus on these particular different levels, but we're talking about the recession, we're talking about the economy. So what matters is the overall.
right, the
You know,
overall level of spending, which I'm getting. And my question is even though you expect the average to stay relatively where it is, are you seeing any data that shows, we've heard about the K-shape economy. Are you seeing any data that's showing that the spending's getting increasingly concentrated on the wealthy who have money and that more and more of the lower half of the K is getting left behind? Or it just seems like things are pretty homeostasis?
So the lower end of the spending has come up, and but it's low. It's come up from low levels, but it's still low. And then
Okay.
people don't make a lot of money. They make more money now, and it's come up quite a bit. The biggest pay increases were at the lower end of the spectrum, but it came up from very low levels. So it in dollar terms, it didn't really, in percentage terms, it gained quite a bit. But in dollar terms, if you have a high percentage of a low dollar figure, it's still a low dollar figure.
Hmm.
And so you see that. And then somebody who makes $1 million a year and gets a 2% raise, yeah, that's $20,000 a year more. And that's a small percentage, 2%, but it's $20,000 more. That's a lot of money. Yeah, there's a lot of dollars. And so we've had that issue where the people that had good incomes, they got also higher incomes. And then we've had this whole issue of asset prices going up, and people feel very confident. Wealthy people who are now wealthy, or who feel they're wealthy because the home prices have gone up, they feel more confident to spend, and so they spend more of their income rather than having to save. And that we have seen. That is in the data. We've seen that the savings rate among the people who have lots of assets is come down. They spend more of their money. They don't spend all of it, but they spend more of it. They still save some, but they spend more than they used to, and because their asset values have doubled or tripled or whatever over the past 5 years. And so now they feel much more wealthy, and they feel like, okay, on a day-to-day basis, we can spend more of our income. We don't really worry much about savings because my 401k is full, my house has doubled. My cryptos have gone up by 1,000%, and all this stuff. And so we do see that there's a lower savings rate. So they're still saving some of the income. They're not spending all of it, but it's lower. And they're feeling more confident. So when you have asset prices selling off, and I said this in a recent article, and I think that's when we get the recession. When asset prices sell off, the big spenders, the people that contribute a lot of spending to the economy, they'll cut back,
Yeah.
and they'll feel less confident, and they start saving more and spending less. And then we'll see that. And and those are also business decision makers. They have their own companies. So they'll cut back on hiring, they cut back on investments, and they cut back on wage increases for their employees. And so you get this whole chain reaction when these big asset holders, and people who have ownership of companies, uh, who are worth maybe billions, and who lose half of their net worth when the market sells off, they're going to get a little scared. And so it's not just their spending, it's the company spending that hits the economy. And we've seen that during the dot-com bust. That's exactly what happened. So it ricochets through the economy. And so I think that's the real risk that this, in terms of recession, the real recession risk this economy has is a sell-off, a big sell-off in the financial markets. And I think the consumer right now, the consumer is doing fine, but when we get this big sell-off in the markets, that's when the big spenders and the decision makers, the corporate business decision makers, the small business people that feel very good now about their business, that's when they start cutting back. And I think that's the issue we will face and that's my bet. When we get a big sell-off in the stock market, that's when we'll get the recession. That's my bet.
Okay. I want to end on talking about the market. One last question on the high-end consumer here. So listening to you, it sounds like you're saying, hey, high-end consumers doing pretty darn well. In fact, like they're not saving that much anymore because they're not that worried. They don't feel like they need to save. They're out there enjoying, their high stock prices and their high home prices and everything like that. And I'm sure there's a fair amount of that going on. And again, you're way closer to the data than I am. But I think of like the latest earnings call with Walmart, where Walmart has done very well in recent years, and one of the reasons that they've cited that sales have been really strong is they've seen more affluent customers shopping at Walmart, and some look at that as downshifting, right? Where these were people who would buy at more luxury brand retailers, but now even they are beginning to become a little more cost conscious, and so they're downshifting and now spending at Walmart.
Okay. So let me contradict you a little bit here.
Okay.
So Walmart has become a huge e-commerce company, huge, second largest behind Amazon in the United States. And so when you go shop online, you see Walmart stuff. It's everything. They have third-party sellers. They're on Amazon. And they have high-dollar stuff and low-dollar stuff. And so what Walmart has done, and their growth rates in their e-commerce business has been 20 to 30% year after year after year. And it doesn't matter what. They have grown their e-commerce business by leaps and bounds, and it continues to grow. The other thing that Walmart does that's really strong is the grocery sales. And so they've become the largest grocery store in the country. And everything in between, so what's in the brick and mortar stores, all the other stuff, the patio furnitures and the clothes and all that stuff, that's been going flat to downhill for years. And so the growth comes from e-commerce and from grocery sales. And I don't know about and you can buy these groceries online. You can pick them up at the store. You can have them delivered. And so anyway, the online stuff is becoming a very significant part of Walmart sale. And that is independent of e-commerce is across the board. So
yeah, you're saying that they're just buying market share of those higher end dollars for those things. It's not the people weakening; they're just getting more of their purchases.
When I look online all the time because I buy almost all my stuff online, and I constantly see this Walmart. So I bought stuff at Walmart because it showed up when I was looking for stuff, and it's not necessarily cheap stuff. It's just normal stuff you would expect to buy somewhere on Amazon or on Home Depot or at any of these places, and so Best Buy, and they have computers, got everything. And I think they're capturing more with the e-commerce business, they're capturing more of the higher end consumers simply because it's e-commerce. And e-commerce is a great equalizer. And then the other thing I think they're doing, they're capturing some of the business from the dollar stores. So there's just upgrading, because the dollar stores are all going out of business. They have real problems. Right. They're really low end. They kind of rip you off. They sell you one toothbrush for $4 or something, and then you go buy online. You buy 10 toothbrushes for $12. And so people have figured this out. And so this dollar store business has deteriorated for years, and several of them have shut down, and hundreds of stores have closed. And these people are upgrading to e-commerce and to Walmart and to other stores. And that's, Walmart forecast pretty good growth rate for 2025. So it's lower They forecast a slower growth rate than the kind of boom rate they had in 2024, but it's still pretty good. So they're not forecasting any kind of weakness. They're forecasting solid growth, very nice growth in their sales, and in part
All
because
right,
they're capturing.
I'm gonna push back on that one just a little bit, only because, and first off, good explanation on my first point. So yes, that's a great counter to the concept of, oh, these are wealthy people that are downshifting. You're like, no, they're just Walmart's expanding more in e-commerce and just gaining share of their transactions. So I totally get that. If you remember, when Walmart had its earnings release, the stock was down 6% in the aftermarket, and the reason why was because the CEO said that they see slower growth ahead in all of their different customer categories, including the higher end customer. So
But slower growth.
not negative growth,
Yeah.
just slower growth, right? Yeah,
From
exactly.
the huge amount of growth they had in 2024. That's the thing, they had this extraordinary growth rate
All right.
in
So
2024.
you're just saying law of large numbers is catching up to them.
I don't remember the exact number, but I think they forecast 5% growth. And lots of their prices have come down. And so this is growth despite some of the price rollbacks they had that they're
Okay.
forecasting.
All right, but underscore, you're doing a good job of saying, hey, I'm not seeing Walmart as any
Yeah.
sort of
When I
canary in
see
the coal mine
I,
here.
Walmart is just a bad example because it's doing a pretty good job. There are other retailers out there that are suffering. That brick and mortar retailers that haven't switched to e-commerce enough, and we see a lot of there's a bunch of bankruptcies. So
Right.
they're getting run over by e-commerce. So we have those
Yeah.
examples.
Now there are other examples though of brands that the higher end customer purchases from that are struggling. So a lot of the luxury retail brands have been hurting. The Rolexes and the bag makers, and certainly the toys, right? The you know snowmobiles, the jet skis, the ATVs, things like that, RVs. All those sales are down a good amount. Again, I'm not trying to make the case here that we're going into recession at all. I'm just saying there is some data out there to suggest that even the high end is eroding a bit.
And it's interesting. I don't really study that high end that much because it's not that impactful on the overall economy. But it's interesting these stories that you hear during the pandemic and cryptos. They went up 1,000% in no time, and people went out and spent this money. They bought Lamborghinis and snowmobiles and all kinds of
Right.
stuff. And then you have a product that you sell a few thousand off a year, like Lamborghinis. So you have. 200 crypto people buying Lambos, and that makes a big number, in percentage terms, and then and it kind of fades out, and then you got some issues in that spectrum, and people go to jail over it, and you get those kind of things going on, and then the enthusiasm fades, and the Rolex is not, and from what I have heard, a lot of the buying during those years during the pandemic was from the crypto people and who'd made these huge gains, and that portion of it has kind of died.
Died off. Yeah.
And so
Yeah.
I don't
What?
know. I mean, it's not really just stories I hear and I read, and it does not impact the economy in any significant way. So it's just kind of fun
Yeah.
to think about.
Okay, but to put a point under this, you're saying, hey, look, I'm not seeing an erosion of the consumer spending to worry me right now, and the affluent consumer who's carrying a lot of punches above their weight in terms of spending. You're not seeing too many worry signs there as well. Your worry, which you don't really have a timing around, is that, hey, we're vulnerable to a pretty substantial downward repricing in the markets. And when that happens, and I'm guessing especially if it happens in a relatively short time frame, not a slow grind, like a 2022, but more like a, hey, after the past couple of weeks, the market's down 30% or something like that. That's what you think could really trigger the next big economic downturn.
Well, I'm sure of that. So if we get, and I don't know what the line is. The line may be at 30% or at 35%. And I don't know whether there has to be a one-day crash. Probably not. I think if it grinds down over a 3-year time period, that's psychologically devastating. And at some point you'll see a recession. And dot-com bust did exactly that. It was 2.5 years. And right in the middle of it, we got a recession. So we had the bust started in 2000, in March 2000, and then in 2001, mid 2001, we started a recession. And by that time, the Nasdaq was down, I don't know, 30 or 40%, something like that, and it continued to grind a lot lower. After that, and we came out of the recession, and the markets continued to grind lower, and that's the risk I see, because valuations are in the same ballpark really as they were before the dot-com bust, and we have the same kind of dynamics, we have the same kind of exuberance, and that's the risk I see, that when that ends, when people who have made large amounts of money, and now some of them are leveraged, and so they will lose most of their assets, like in no time, and that will stop their spending in their tracks. And it did back then. People try to get their day jobs back, and um, it. I'm sure that we will get a recession if there's a significant stock market sell-off.
All right. So we have this sort of Damocles hanging over our heads right now, right? We have your assessment of a dangerously high probability this is going to happen at some point, right? Don't know if it's tomorrow, don't know if it's a couple of years from now, don't know if it's going to be quick, don't know if it's going to be a long grind. What type of investment strategies, or like as you this channel's watched by regular investors. None of what you're saying here is personalized financial advice, so you've got that disclaimer. But like, how would you think about managing your capital through a year like this one you've described, where the economy will be slowing? Odds are good for that. There's uncertainty that it could get even worse. If Trump ends up, one of his policies ends up really triggering something black swanny, and we've got this market sort of Damocles over our head. I'm going to guess you don't think being super aggressively long, consumer discretionaries is a great thing in this environment. So, like, what strategies make sense to you in this type of environment?
Well, I'm still following my mantra of T-bill and chill.
Okay.
I don't feel like investing in the stock market at all. It just doesn't make sense to me. It's too risky. I don't know what the gains would be. I know the risks are very high, and the payoffs seem to be fairly low to me right now at these levels. But if you have stocks you bought a long time ago, and you're up tenfold or 20-fold or something, that's one thing. But if you take some cash now and invest it in the stock market, I think that's a very risky thing to do, and I wouldn't do that. And personally, I don't do that. I mean, people talk about gold. I'm not a huge fan of gold, simply because of the storage issues and other stuff that goes with it. But I think for long-term investors, that's always a good thing to have. And um, it but then again, it's fairly high now, and it's gone up a lot. So if you're buying now, you're buying at a fairly high price, and so that's the thing we have. And there are a lot of assets that seem to make sense, but they've come up a lot, and so you don't want to be in a position where it's buy high, sell low, and T-bill and chill means you're really not exposed to any capital loss. You're making interest around 4%, a little over 4% now, and you're not exposed to any kind of credit risk. It's very liquid if you have them in your brokerage account. So if something blows up, I mean, that's the back of my mind. If something blows up, liquidity just vanishes from the market, and he who has the liquidity can buy at a very low price all kinds of stuff. And you can sell T-bills within moments out of your brokerage account without really taking any kind of capital loss, because they're short term, and so whether interest rates go up or down doesn't really impact the price that much. And and you can buy stuff with it if events turn badly. And so I think for me, that's right now, that's an appropriate strategy. And people, I mean, I really, let me just say this many times, if you have something that you bought a long time ago and you have a low cost basis in it, and you face a huge tax bill if you sell it, I mean, that's not really what I'm talking about. Now I'm talking about putting cash into the market right now, and I don't think
Mhm.
that's a good idea.
Okay. Yeah, it sounds like you're sort of taken from the Rothschild playbook right now, given your concerns, which is build dry powder. And if indeed what you think may happens, you get the opportunity to be, quote unquote, buying when there's blood on the streets and getting deep value, and then hopefully riding that back up as the markets recover.
Yeah.
Yeah. All right. Well, look, Wolf, we're here at the end of the hour. It's always great talking with you. I've got one last question for you, which I'll save for the very end. But first, for folks that really enjoyed this discussion, would like to follow you in your work as well as your excellent charts, where should they go?
Wolfstreet.com. Everything is free, no paywall. Great comment section too.
All right, great. And Wolf, when I edit this, I will put up the link there so folks know exactly where to go. Folks, the link will be in the description below the video as well. Well, folks, look, please thank Wolf for coming back on by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help in thinking through how to navigate this market, with your portfolio, highly recommend that most people watching this should get that help from a professional financial advisor, and very importantly, one that takes into account all the macro issues that Wolf has laid out for us here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel every week. To set up one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations, as I said, are totally free. There's no commitment to work with these firms. It's just a free public service they offer. All right, Wolf, last question for you. We've talked a lot about some of your big concerns here. As we wrap up, let's try to end on a more positive note. What's a source for optimism for you in the current situation? Like, what are some of the things that make you think, oh, this is working well, or this is actually going to make things better in the future?
Well, I like the policy changes and the movements we've seen in terms of manufacturing in the United States. That has been a huge issue, that we have abandoned manufacturing, and the United States is still the second largest manufacturer in the world, and larger than the next three combined, but in terms of value added, but we're a lot smaller than China. And we have the largest economy in the world. It should be the largest, most advanced manufacturer in the world. Manufacturing is hugely important for the economy, for people, for wages, for all kinds of things, and throws off a lot of secondary, tertiary benefits. And we've seen a construction boom in manufacturing, so factories being built everywhere. And I have a chart on that, an annual chart, so you see how it just shoots up. That investment in production is hugely important, and I'm super glad I'm seeing this finally, after over a decade of yelling about it.
Mhm.
And and I think it will be a strong long-term benefit to the overall United States economy, to wages, to the middle class. And manufacturing jobs are no longer these low-level jobs. There's tech jobs, they're high-level jobs in terms of skills, and these are automated plants, not sweatshops. So most of the stuff is made by machines, and so you have to design the machines and manufacture machines and maintain and service the machines. You have software engineers, all those kinds of things. So this is a whole new a new labor force that we're building to handle that manufacturing, and it goes into education. You have to train those people. So this is a really good thing, and I'm really glad to see that. And I think it's going to have slow moving but big positive effects in the future.
Okay. Well, presumably those factories that have been getting built in recent years, it takes a while to build the factories. So we've sunk some real cost into there, but the benefits are still coming in the future. So hopefully that should flip into an NPV positive return for us. And also you mentioned too, we're hearing, more and more stories about, big companies. You mentioned Apple committing, I think it was like $500 million. There's another story that came out a couple hours ago about NVIDIA just, basically committing it's going to spend hundreds of billions of dollars here. We've seen it from several other big companies around the world. I know TSMC, similar deals. So, we are beginning to see commitments of really big sums to fund new manufacturing jobs here. So hopefully, from your lips to God's ears, that this sparks a new manufacturing renaissance here in the U.S.
Yeah, and this kind of manufacturing is really high tech. So this is an expertise that we were in the process of losing entirely as a country. And so we're reestablishing ourselves with that. We don't really have the trained people to do that. So this is really a long process. But this is why I feel so good about it, because it involves so many things, and it's not low level manufacturing. I said nobody's gonna make t-shirts. They're already making t-shirts in the United States again, So Walmart's buying them. So it's amazing what happens, I mean, my long theory that nobody's gonna make t-shirts in the United States got shot down, because it and to me that part is long term. So you're looking at many years, but to me that is a very exciting thing to see, and I'm super positive about that.
All right. Well, it's wonderful to end on a positive note. Wolf, can't thank you enough, my friend. Great discussion. Look forward to having you back on the program again soon.
Yes, thank you.
All right. And everybody else, thanks so much for watching.